Manish Sonthalia, and we have him as well. Kush Bora, I know we haven't come to you, we'll come to you in a moment, but I just want to do a small conversation with Manish Sonthalia. He's Director and Chief Investment Officer at MK Investment Managers and joins us right now on the show. Manish, great having you. Thanks for joining in. And the reason I say it's great having you is because it's important to try and understand what do you think about the near-term trend. One is that because there's incessant selling, the easy answer is that there is very high probability of this going down further. Is there an extent that you have penciled in mind where you will believe that the valuations are starting to look interesting, or is it a moving part depending on what happens to earnings and the global macro?
So, Neeraj, for some time it was very clearly known that India's earnings are not going to be more than 10 to 12% for FY26 and FY27. In that backdrop, Nifty 50 would not support levels beyond 22,000, 22,500. I mean, that was a very clear given. Run up to Modi ji's results, the third term, on June the 4th, if I'm not mistaken, June the 4th, the levels on the Nifty were closer to 22,000. Now, in the euphoria of this 400 seats and whatever number was touted at that point in time, we took the markets up from 22,000 to 26,200. That was the excess part. And now, because of that excess being given up, we are looking at the levels back to being normalized at around 22,000. So the sense that I have, based on just fundamentals, pure fundamentals, is that markets will broadly bottom out closer to that 22,000 odd level. I firmly believe that markets would not sustain below 22,000 for a prolonged period of time. I don't know from where the buying is going to come, but clearly there will be merit in buying India at those levels. Secondly, Indian currency was overvalued. That was also clearly known, and Indian currency has depreciated. In the last 1 year, February 24 to February 25, from 82 rupees 90 paise to 87 and a half or 87.90 yesterday. So that is also closer to around 88. Maybe we'll go down to 90, but that would be the worst. So I would believe the last 5% is where the maximum capitulation is happening. These are great times to buy, and as we have seen in previous crises, whether it be the global financial crisis or the COVID times, whenever there's this such letting down of the, just throwing away stocks at any price, those would be great times to buy. Now, as regards the mid and small caps, again, there was a caution that, yes, valuations were running ahead of previous highs that we have seen in Indian markets. Some 35, 40p, these were not sustainable. But it would be not correct to actually paint the entire mid and small cap space in the same brush. My sense is that if, let's say, the Nifty is trading at 20p and the outlook on Nifty earnings is like 10% growth. Now, mid caps and small caps, if you are looking at buying more than what Nifty earnings growth is and valuations closer to Nifty earnings valuation, you should broadly be fine. So just to say that the mid and small caps will fall down big time, I don't think that's there's enough merit in that, because if you just look at even the large caps, leave aside the Nifty 50, the Nifty 50 next in the month of January has also fallen some 7%. So just to say that large caps will do well and mid caps and small caps will not do well, I don't think that's going to have too much of a sound logic at this given point in time. It's too late to sell. This is the last bit of capitulation that you're seeing in the markets. Rupee has broadly fallen, maybe another 2 to 3%, and markets would have broadly fallen another 5 to 7%, 5% at the maximum, I would believe, and there would be comfort in buying at those.
Harsh, I don't know if Manish turns out to be right or wrong, but this is the advice, and this is the answer that is needed. One, that it is too late to sell a lot of things also, yes. And two, the market capitulates around these levels. I think this is the answer that is very much needed. In some sense, Avinash spoke about it others, but Manish has just encapsulated it beautifully.
Yes, absolutely, Neeraj. Manish, Harsh also joining in. What I'd really be curious to understand from you on a day like this is, bulk of the pain has been faced by stock sectors and segments which are fast growing and where earnings for many, many years into the future, even though still realistic, were discounted. Um, in the next 1,000-point odd fall that you broadly are suggesting will happen, what will be those sectors which will face a bulk of the pain? Will it still continue to be these segments?
No, so see, the budget that was presented, highlighted a few things. First is that the government's inability to spend more than 10 lakh crores. The last year budget figure of 11.11 lakh crores has been whittled down to 10 lakh crores. My sense is that the number of projects, etc., still needs to be finalized and all of that. So, sectors which were trading high beta and very high valuation based on order book figures for the next 5 years. And I have alluded to this fact that long dated order book positions can't be valued in the near term at the valuation that with the markets were valuing. So all the investment, this budget has basically told you that the pendulum swings away from investment related themes to consumption related themes. So I think the maximum brunt of selling is happening where PEG multiples are more than 3, and it could be in any sector. But broadly, what we have seen over the last 3-4 years is that the capital goods, infrastructure, railways, defense, power, renewables. I mean, it has been glorified a lot, and you are pricing in, let's say, the next 5 years of earning. I mean, that would not stand, and that is what is basically likely to face the maximum brunt of the selling. On the other hand, given this 1 lakh crores of savings, creating a multiplier of anywhere between 3 and 5 lakh crores on the consumption side. The consumption, which has not done well in the last 2-3 years, is going to be the new bright spot in the markets, particularly the discretionary side of things, which has been quite overlooked for some time. Because not only would you likely see earnings growth, but you could also see some multiple expansion, because you're talking about the multiplier of anywhere between 3 and 5 lakh crores, and the 8th pay commission recommendations are yet to come. And if the fitment factor is anywhere between 2-2.5, then of course that's again going to be an icing on the cake as far as the consumption is concerned. So the glorified sectors of the yesteryears, last 2-3 years, which had gone out of sync, whereas the earnings and the valuation are likely to correct more. Where there is value, deep value, contra, the banking, the insurance, these are some of the places which are likely to happen.
Okay, Manish, if indeed, just one question from mine, and that's this last question from mine at least. The government, in order to reach the targets as they set out for FY25, would mean significant capex uptick in Feb and March. Sequentially, it will look very strong, but even an absolute number would be large, number. And therefore, the news flow would be strong, right? Would it therefore entice, and some state level capex numbers as well are looking solid, right? I mean, Andhra Pradesh is doing this whole new city, etc., so on and so forth. Bihar might do that. Would some of the infra, capital goods, cement led names look possible candidates? Because there too, the correction has been fairly swift.
So cement is clearly a proxy on housing, and given the impetus that is given on, 2 houses for self-occupied being away from the tax bracket, I mean, that's going to be beneficial, and obviously a lot of impetus on, household savings. That's going to be beneficial. So anything to do with home improvement, yes. Anything to do with, let's say, near-term capex, and obviously the numbers are going to be 1 lakh crore for, let's say, February and March. That is the capex number if you have to achieve the 10 lakh crore figure for fiscal year 25, that budget. But mind you, the valuations which are getting captured for, let's say, FY26, and the numbers before the budget was anything like a 20% growth on top of 11 lakh crores last year, revised estimates of FY25. I mean, those things are not happening. So from that point of view, I mean, the infrastructure, capex related over ownership, over valuation has still room to correct. But home improvement and cement and tiles and the plyboards, furniture, and all of these things would come within the consumer discretionary space. Building materials, those would be standing to gain according to, because the valuations are extremely comfortable, and you are looking at a growth cycle as far as the building materials per se is concerned. So that would include even the paints. They have also not done well. Everything related to home improvement, because there is more money in the hands of the consumer, likely to do well.
Okay, Mr. Sonthalia, great having you on a day like this, and getting that perspective. Always a pleasure. Thanks so much for coming in and speaking with us and being very patient
Thank you.
because of the last minute cut in that we had to do.